since we are ending the financial year, and it's about tax harvesting. It's very, very important to understand tax harvesting concept very clearly, because not many understand it. People confuse it with, profit booking and various other concepts. So it's very important that you understand this video very carefully, go through it again and again. If you have any confusion, you can write to me if still there is a confusion after that. But it's vital that you understand it and you implement it. It's to be implemented by everyone. It's not that you cannot implement it this financial year, or you don't want to sell off your equity. Once you understand the entire idea behind tax harvesting, you would truly appreciate why is it so important to implement this concept every financial year. And since we're, right now almost at the verge of end of financial year, it's very important that we understand it clearly and take action quickly. Okay, let's go. So we're going to focus right now only on equity capital gains, though tax harvesting is equally applicable for any kind of capital gains. Okay, it could be real estate capital gains or equity capital gains, and you can merge these two gains together to implement your tax harvesting. But right now, from an examples perspective, we'll focus more on equity capital gains. Okay. So, what is harvesting? As a basic concept, we all understand what harvesting is. When your investments start to yield result, you harvest some of those results because that's the right time you should be doing it. Okay, that's what farmers do, and that's exactly what harvesting is all about. Gains are always realized by harvesting them. Okay, so now what is tax harvesting? Similarly, as you saw the farmer, reaping some of the gains or harvesting some of the gains from the seeds he sowed earlier. Similarly, all the investments you have done so far, some of them which have already gained in value, you must harvest them at an appropriate time. Again, don't confuse it with profit booking. We're going to, circumvent all that and understand this as a concept. Okay, so be very patient, be careful, listen to it very carefully, because this is a very, very vital concept and one of the most misunderstood concepts that I know of. So just be very careful when you're trying to understand this concept. So as your wealth is growing, you should actually harvest some of the growth, or some of the gains that you have in your wealth, and it will help you save a lot of taxes, and it will also help you do a lot of other things. It can make your portfolio more efficient, it can make your portfolio give you better returns, it can balance your portfolio, it can do a lot of other things while you harvest your taxes. Okay, so be very watchful as I take you through some examples. So why should tax harvesting be done? That's a fundamental question. Okay. So first, it's going to help you improve your portfolio balance if your portfolio is unbalanced. So that's an opportunity for you to balance out your portfolio. Okay. It also improves your portfolio efficiency because you're going to talk about, moving from certain set of asset to certain other set of asset within equity, for example, and that's how you're going to improve your portfolio efficiency. So we'll take some examples for that. And of course, it's going to save you taxes. It's going to save you the taxes this year, and it's also going to save you taxes in future. So harvesting that you do this year will save you taxes this year, plus it's going to help you save you taxes in future also. So we're going to read about that, of course, more. And it'll also never break your, idea of compounding. A lot of people feel that when you harvest gains, basically you're breaking your compounding. It's not like that. This is a very, very misunderstood concept that it's going to break your compounding. So it's not going to break your compounding. Okay, so let's understand the architecture, how tax harvesting actually works. So this is the basic fundamental architecture of tax harvesting. You realize certain capital gains in a financial year, then you have two choices. You either pay taxes on those gains, or you use what we call as an LTCG bucket, okay, which is long term capital gains bucket. Okay, when you use this bucket, you're going to pay zero taxes. Not only you're going to pay zero taxes, plus you're also going to improve your portfolio balance, you're going to improve your portfolio efficiency, you will not disturb compounding while you're doing all that. So it's very important to understand this. And realization of capital gains could be done because of specific reasons, and if not, you should realize your gains even if there is no specific reason, by doing tax harvesting. So we're going to talk about it very very clearly with examples. It's very important that you do it every financial year. So for understanding why it's important and how it actually works, we're going to talk about two very important concepts: the net gains, as you see highlighted in this picture, and we're also going to talk about LTCG bucket. What is it? So we're going to define what net gains is and what LTCG bucket is. So remember, we're going to talk about only equity right now, and we're going to talk about a concept of within the framework of a financial year. Okay, so let's go. So what are net gains? So this is the architecture that you just saw, which I just showed you in the previous picture. And now we're going to understand what net gains actually mean. And when we say net gains, we're talking about one financial year. So net gains in a financial year is a combination of your short-term capital loss, if there are any, plus short-term capital gains, again if there are any, plus a combination of long-term capital loss plus long-term capital gains. So basically, you're going to combine all your losses and gains in this financial year and use this net gains to do tax harvesting. How to use it, I'll tell you later. But first, understand that you can combine all of them together. A lot of people are confused whether you can, adjust your short-term capital losses against long-term capital gains. So this makes it very clear that you have to combine everything together for a financial year, and that becomes your net gains. Now, remember that if you are rolling over certain losses from the previous years, as per your ITR return, then you can use those losses also to combine it here and calculate your net gains. Okay, so that's very very important concept. Okay, so let's take an example, a very small example and a very simplistic example for the ease of understanding. Let's say your short-term capital losses this financial year were 50,000, or they were probably carried over from the last few years, and you had a gain of around 30,000 and short-term capital gain, and you had a long-term capital loss of around 1 lakh and a long-term capital gain of around 1 lakh 10,000. So there's just numbers to explain you how net gains has to be calculated. So that's how you're going to add. Losses are going to be negative and gains are going to be positive, and your net result is minus 10,000 rupees. So that's your net gains in this financial year, considering all your short term and long term gains. Now, remember that this concept of net gains is equally applicable for equity as well as real estate, because it's all about capital gains. So, both of them are capital assets, the real estate and the equity. So, it's valid for both. So, if you have some losses in your real estate coming from the previous financial years, you can adjust them here and calculate your net gains. So, the lesser the net gains is actually going to be good for you in terms of tax harvesting. Okay, and suppose you have not liquidated anything this year and you're not carrying forward anything from the previous years, so which means there's no realized gains this year and nothing carried forward, so your net gains in that case would be of course zero. So that's for the ease of understanding. So let's understand the second important concept, which is the LTCG bucket. So this is the second concept which we highlighted in the previous architecture picture. So what is LTCG bucket? So now you've understood net gains. Now we're going to talk about LTCG bucket. So there is something called as a refill, which is available to every individual who is filing tax returns, and the refill is exactly rupees 1,25,000 every financial year. Now this, when I say refill, the idea is that this gets refilled every year. So if you don't use it, it just goes away wasted and it's refilled next year again. So it's important that you don't let it go waste within a financial year and use it. How to do it? Of course, have patience. I'm going to tell you that. So now, there's something called as available LTCG bucket. So we calculated net gains in the previous slide. You saw that. And we know that there's a refill available every financial year of 1,25,000 rupees. So we're going to calculate what is my available LTCG bucket if the gains, net gains were what we calculated in the previous slide. So available LTCG bucket will be 1,25,000, which is a standard value as per the latest budget every financial year, minus if there whatever are your net gains. If your net gains were negative, so you're going to write it at minus rupees 10,000. If your net gains were positive, you're going to write the same amount. So if your net gains were negative, you're actually going to end up with a available LTCG bucket which is higher than 1,25,000. So it would be 1,35,000. So that's your available LTCG bucket, and it's so important that you calculate it correctly to maximize your benefit of the entire tax harvesting concept. Now, remember again, as I said earlier, refill is done every financial year. So, if you don't use this, it's gone forever. It's very, very important that you use it within a financial year. If you're not going to use it, it's a waste of your taxes basically, and you're not going to ever get it back. Okay, and unused refills are totally wasted. So, you're going to again get the next refill next financial year, and this will never get utilized. So important you utilize this available LTCG bucket which is derived from the refill. So you can liquidate your equity up to the available LTCG bucket without paying any taxes. So which basically means if your available LTCG bucket is 1,35,000, so you can go ahead and liquidate. Let's say if you had invested around 4 lakh rupees, and you liquidate it now, your gains are, let's say, 1,35,000 rupees out of that. I'm just taking a very rude example. So if you had invested 4 lakh, your gains are 1,35,000. So your total amount today is 5,35,000. So you can actually liquidate 5,35,000 rupees today, and your gains would be 1,35,000. And since you have an available LTCG bucket this financial year for 1,35,000, you don't have to pay any taxes on 5,35,000 liquidation that you do. Okay, so that concept is so important to understand. How much you can liquidate will depend on how much gains you have. If 3 lakh yielded like 4,35,000, then on you can liquidate up to 4,35,000. So basically, you can liquidate the amount which is showing you a gain of 1,35,000, so that you are within the available LTCG bucket. If you liquidate more, nothing untoward is going to happen, but you're going to pay taxes on the additional liquidation. Suppose you liquidate more amount, let's say you liquidate 5 lakh, and in that your taxes were like 1,55,000, which is like 20,000 more than your available bucket. Then you're going to basically pay taxes on the 20,000 rupees. But right now, if you liquidate within this bucket, then you don't pay any taxes. Okay, so you need to understand your own calculations of how much you can liquidate in this financial year. Okay, but there are a lot of people who come back and say that, okay, I don't want to liquidate. This is not the right time for my equity to be liquidated. For example, if markets are down today, why should I liquidate? Well, that's a very valid question. And suppose I bought a stock and it's still going good. I don't want to liquidate right now. I want to let it grow, which is a very fair ask. But still, you can implement tax harvesting in a different way, which we call it as vanilla harvesting. Okay, so that if you don't want to liquidate right now, don't liquidate, but follow the concept of vanilla harvesting. This is the most simplistic form of harvesting. Okay, now this is where the entire crux comes. Okay, so it's not just about liquidation. So what is vanilla harvesting? You harvest gains, basically you liquidate, as we discussed in the previous slide. You liquidate up to a certain amount which is within the bucket, and then what do? You don't want to, you never wanted to liquidate it, but so you liquidated, you use the bucket, and now you're going to put everything back. Okay, so you had a, let's say, a stock worth 100 rupees. You use the bucket, you liquidated that with gains, you utilized the bucket, you didn't pay any taxes on that, and you reversed everything back and invested that. So you, let's say 100 became 120, the 20 rupees was gains, but you used the entire 120 and invested it back. So basically, when you do that, this is the entire concept, which is not very easy for a lot of people to understand. So this is the most simplest form of harvesting you can do, vanilla harvesting. Now, this term you may not have heard anywhere. This is a term which I have derived, which is the entire idea of harvesting. You're not disturbing compounding here. Okay, so you're not taking anything out, neither the gains nor the principal. You're taking it out, using the bucket and sewing it in. Okay, so that's the whole concept. What is the benefit of doing that? We will talk about it. First, there is no net liquidation, so investment stays intact. So there's no difference to compounding. So your money and your returns and your gains and everything keeps growing. Okay, that's point number one. Second, your current tax is reduced, because if you had certain capital losses to adjust, you were able to adjust against the gains, and therefore your current taxes will come down. Okay, and third, your future tax is also reduced. Because why? Because when you liquidated, you liquidated something which was invested, let's say, 2 years back, which was bought at a certain unit price, and now you've liquidated it, and now you've sold everything back at a higher unit price. Now what happens with that is your future gains get reduced. Okay, because now the unit price has gone up, the invested unit price, and your actual unit price is the difference between the actual and the invested price has come down, and therefore your taxes in future will also reduce. That's the whole idea of vanilla harvesting, which is a part of tax harvesting. Okay, so this is tax harvesting done in the most simplest format. That's, we call it as vanilla harvesting. Okay, so that's what you should be focusing at. Now, what else can you do? I mean, this is very simple, that you can just liquidate and invest it back, and use your bucket, don't pay any taxes, and reduce your future taxes also. And if you have any current taxes, you can reduce them also if you had any losses. Now, what are the other important uses? Can I do only this much with tax harvesting, which is in the specific form, which is vanilla harvesting? No, this is just one standard use case of tax harvesting. What are the other use cases? Vanilla harvesting, as we talked about, saves your current and future taxes. Okay, but you can do a lot more, as they talked about. So instead of sowing back your gains in the same asset, now you can get smarter. Where do you sow it back? Okay, within the same market, I understand, because we don't want to play with the market. We don't want to take the risk of liquidating it now and waiting and timing the market and waiting for the markets to go up. No, that's not what we want to do. We want to go back into the same market at the same time, liquidate and go back, but probably not in the same asset. Okay, so we're going to talk about different use cases. First, when you liquidate, if you have certain regular funds, you're going to liquidate your regular funds and get into direct funds instead, while going back, okay, while sowing it back. So when you do that, you make your portfolio more efficient. Okay, if you don't have regular funds, of course this use case is not for you. But if you have regular funds, this is an opportunity to switch to direct funds without paying any taxes. Otherwise, people, a lot of investors keep waiting. Okay, if I liquidate regular and move to direct, I'll have to pay taxes. So this is an opportunity to use the bucket in every financial year and keep moving from regular to direct. Okay, don't miss this. Similarly, move from dividend to growth funds. Okay, there's no point having dividend funds. I mean, if you read the book Foops, which was published a couple of years back, and if you understand the idea of dividends, they are very, very inefficient. So move from dividend to growth funds. Okay, when you talk about funds, we're talking about equity funds. Rebalance your portfolio. This is an opportunity where you can rebalance your portfolio, because if your portfolio is imbalanced towards equity, then you should be moving from equity to debt. If your portfolio is balanced against equity, then you should be moving actually from debt to equity. So if you're moving from equity to debt to rebalance your portfolio, if your equity portion has gone too high, then this is an opportunity for you guys to liquidate your equity, don't pay any taxes, use the bucket that's available, and then move your investments to debt based investments. So that's going to make your portfolio more efficient. What else? You can move from poor performance to better performance. So you have certain stocks or certain funds which have just been hanging on there, not yielding any much results. So that's an opportunity. Discard them, simplify your portfolio, make it more efficient, move from poor performance to better performance. Whether it's stocks or mutual funds, doesn't matter. So these are all the use cases you should be thinking of when you're sowing back. If nothing works for you, if you think you all have direct funds, you only have growth funds, your portfolio is perfectly balanced, you don't have poor performers, then do vanilla harvesting. You can still use the bucket, you can still save taxes current year, and you can definitely reduce your taxes in the coming years. Parting notes for you guys: if you need the investment within a year, avoid harvesting. Why I say that is because when you re-sow your investments, they're kind of considered as fresh investments. So your short-term capital gains may come into picture if you're going to liquidate that within that year. Okay, so we have to be a little careful about when you need your investments. If it's a long-term investment, it makes perfect sense to do tax harvesting. Okay. um, when you are liquidating and redeploying or resowing your investments, be very careful. Fund deployment should be done as quickly as possible, preferably the same day. Okay, because if you elongate the time between liquidating and resowing, then there are chances that markets will move, and that's a risk you carry. So preferably within the same day you should do that. If you want to know certain techniques on how to do it within the same day, read this book Foops. This will give you a lot of idea about how to implement the same day movement strategy, so that it becomes market neutral. So you're not dependent on market. And fund movement is market neutral because it's done quickly. If the markets are currently low, you're liquidating it low and you're entering low. Okay, the markets are high, you're liquidating high and entering high, so it's essentially market neutral. So that's a very, very important concept. Again, do not confuse it with profit booking. It has nothing to do with timing the markets. We are not saying the liquidate and keep the money with you. We're just liquidating and going back, either in the same asset or different assets to make our portfolio more efficient. Okay. So this has nothing to do with profit booking. Do not confuse. Profit booking is something which I never recommend to anyone. I think it's a farce concept. Focus on tax harvesting. Okay. So that's primarily the idea behind tax harvesting. If you have any questions, of course, you can write to me. Certain references for you if you want to read the Forbes book, if you want to read the book about stocks, because we're talking about both mutual funds and stocks here in terms of equity tax harvesting. So if you want to understand the concept of stocks more, you can read this book. If you want to understand how this entire idea of financial freedom works, how overall money works, you can read the book Rat Race to Financial Freedom. This is my official website. Log in there and start doing your own planning for financial freedom, own tracking for financial freedom. And this is the program which I run. This is the only program I run, which is where I coach people who are very selected people based on an interview and take them to financial freedom. We are churning out, like, every year we churn out around 10 people, 10 to 12 people who become financially free. Okay. And the latest was the newsletter, which is a monthly newsletter where we talk about the latest events and latest financial events, of course, and of course certain life related skills, and how to get better as a person. What should be our monthly diet in terms of finances and life skills. So that's about it. Happy harvesting. Do not miss this. If you are ending the financial year now, all you got to make sure is you harvest the right stocks depending on the bucket that's available to you, depending on your net gains, and make sure you resow them back. You can do the resowing even in the coming financial year. That's not a problem. Maybe a 1 or 2 days delay is fine, not more than that, of course. But you must liquidate it within the financial year to be counted within the bucket of this particular financial year. Okay, all the best. Hope you like the video. Share it, like it, put your comments, put your feedback. Happy to hear anything that you want to say. Okay, thank you. Bye bye.